this. Okay, so again, this transaction, number 15, is the same exact transaction as this one. Okay, salary is expense, and you're paying them. It's not going to be, there's no liability here. You're actually paying them the cash. Okay, so I can just copy and paste, or at least like look back. Salary expense and cash, 8,000. Okay, salary expense and cash. Okay, so now I'll post this. I'll go to my salary expense. Actually, I think I did this. I already did this part, and I did this. Okay, so I think I've already posted these. I must have just, that's where we ended. Okay, the next one. We meet our clients who pay us in advance. Okay, so we have not actually performed any services. We haven't done anything for this client yet, but they're giving us money. Okay, so uh, what are we receiving? What account is that gonna involve? What are we getting? Cash. Okay, so is that gonna be a debit or credit? Debit, right. So 22,000, we're gonna debit cash. Now, if we had done something, we would have earned revenue, so we would have done 22,000 credit to service revenue, right? But as the transaction stated, we haven't actually done anything to earn this. Okay, so it's, if you haven't earned it, it's called unearned, right? Unearned revenue. And this is a type of liability, right? This is something we owe to this client. We owe them $22,000 of services. They've already paid for it. We just now have to deliver those services. So until then, it's going to be a liability. Okay. And later we're going to see what happens when we actually do the work for them, right? We're going to convert this liability. We're going to reduce the liability and record a revenue. Okay, so you can maybe already see how it's going to play out. If you're going to reduce the liability, it's going to be a debit to unearned revenue, and then we're going to credit service revenue, right? So that will have the effect of reducing that liability. Okay, but we'll see that later. We're going to kind of build upon what we were learning, but I'm just giving you a little preview. Okay, so the last one. Okay, actually, did I post this? Probably not. Okay, so cash, I'm going to debit 22,000. And then I'm going to go to unearned revenue, credit 22,000. Okay, and then last one. We performed. Okay, so this is a pretty simple one. We're just receiving cash for services performed. So I think we've seen that already several times. The amount is 16,000. We're receiving cash, and it's for services performed. So we've earned this revenue. Okay, so I'll do post this now, 16,000. And then service revenue, 16,000. Okay, so if I've done this correctly, I'll see that my debits and credits match, and they do. Okay, this next tab is the trial balance. Okay, you can see this debit and credit total. They're balanced, and all of my accounts are displayed here. Okay, they're all so again, just to make sure, this cash, 438,750. Where is this coming from? Well, if I go back here, I have all these transactions that have affected cash. The balance is this, right? It's a debit balance. We did this, practice this, where we have a bunch of debits and credits in a T account, and we calculated the net balance. Okay, so this 438,750 is after all these transactions, after this month, the total cash balance is 438,750. So now we're taking this balance and we're just moving it to this set of all of our accounts with their respective debit or credit balances. Okay, we're just seeing what the balances are now at the end of the period. And you can see when we do this, so again, just to show you one more, this 11,000, where is it coming from? It's coming from right here, accounts receivable. We had 2 transactions affecting it, and the balance is $11,000 debit balance. So you can see in the trial balance, that's where this 11,000 is coming from. Okay, so we just go and just do this for all of them, being very careful to differentiate between a debit balance and a credit balance, because like notes payable, 520,000. So go to notes payable, it's a credit balance. So I'm making sure that on my trial balance it's showing up as a credit. Okay, and if we do this correctly, and we've done all our transactions correctly, the trial balance will have a balance here. Okay, so let's stop here for a second and just go back to the presentation. Let's just finish off a couple of things. So through this whole kind of exercise that we just did, we were just given, hey, like this thing happened and we did the journal entry. But how does a business actually know what's happening? Okay, so what are the records? What's like the raw material that actually shows what's happened in a company? What are we going to use to make the journal entry? Okay, so how do we even know something happened to the business? So think about this, maybe brainstorm, and we'll see if we can come up with a list together. Okay, so think about this. How do we know? Okay, who wants to help me? What are some records that a business generates? What's like the raw material? Any ideas? Like when you make a sale, how does your business know that a sale was made? Yeah, Chris. Yeah, you have an invoice in the case of a sale, right? You're going to give your customer an invoice or a receipt. Yeah, you're right. Like if you go to Costco, they're going to give you a receipt. Okay, so that's an instance of recording a sale. Okay, what else? How do you know that you have some expense that was paid? Yeah, bank statement. Yeah. Uh, as we saw that this accounting software I was showing you, it pulls in all the data from your bank account, right? So that essentially your bank account statement is showing all the cash transactions that happen. Okay, what else? What's the record that you've paid your employees? What do they get? What do you generate for them? A check. Yeah, so checks, pay stubs. How do you know how many hours your workers worked? What are they filling out? Or like timesheets. Okay? Exactly. Okay, so all these are examples of what we call source documents. Okay? This is like the raw material that's going into your accounting department so that they know what's going on. Okay, so we talked about some of these invoices, checks, your PG&E bill, right? That's going to be a source document that's you, the accountant, have to figure out is that's a utility expense, right? A contract. How is a contract a source document? What if you're like a contractor? What helps you determine what payments come when? The contract, right? So employment contracts, service contracts, they're going to spell out when payments are due, what payments are for. So that's another example of a source document. Deposit slip. So when you go to the bank and you put in money, they're going to give you a little slip that shows that you made a deposit. Your credit card statement. So all these are examples of what we call source documents. Okay, that's what's telling us what's happening, and then we as the accounting department are going to convert those source documents into a description of what happened and then a journal entry. The journal entry actually updates your accounting system, right? Until we made that journal entry, these transactions don't actually exist in the accounting system. It's only when we make a journal entry, do a debit and a credit to certain accounts, that's when the system gets updated and this becomes reflected in our financial statements, in our accounting system. Okay, so we need these source documents. These are These are like kind of the ground reality of what's happening, and then they get turned into information for our accounting system. Okay, any questions on this? So the flow is some economic event happens, some source document is created, that source document is then shared with the accountant or the accounting department of your business. That accounting department converts that source document into a journal entry, and then the journal entry updates your accounting system. Okay? Make sense? Okay. Okay, so again, the trial balance. Okay, this is going to be compiled at the end of the period, and it's going to have all of our account balances. As of all those transactions that happened in the period, we had debits and credits in all the accounts happening, but at the end, there's going to be some balance. Okay, and then we're going to compile all the balances into this thing, this report called a trial balance. And from this information, we're going to make those reports, the financial statements. Okay, so the financial statements are just an outcome of the information that's in your accounting system. What's in your accounting system are accounts and their debit or credit balances. Based on that, you're going to take this information and make the income statement, the statement of equity, the statement of retained earnings, the balance sheet. Because if you remember in the income statement, there's no mention of debits or credits. The balance sheet has no mention of debits or credits, right? That system of debits and credits is just for your accounting system. Once you have the balances, you then format them into a report, okay? And the report may have negative numbers. It's going to have other stuff because it's formatted for a reader, okay? It's formatted for some financial statement user, okay? But in our accounting system, we just have debits and credits, okay? So I think this is a big source of misunderstanding between the financial statements, which are again our reports, and the accounting system, which is based on our system of debits and credits, okay? But they're related in that the balances that you get from your accounting system, that's what you're going to use to make your financial statements. Okay, is there anything unclear about this? The difference between your financial statements, which are reports, and your accounting system, of which this trial balance is part of, as a system of debits and credits. Is everyone clear on that? Okay, so again, there's no negative numbers here, but on the financial statement, we're going to see negative numbers and things being subtracted away from each other. But it's really just a debit balance netted against a credit balance. That's what it's going to be. Okay, that's what it's happening in the accounting system. And we'll see some examples of that with like depreciation, where you have a balance for, you can see equipment has $20,000 balance as a debit balance, but the depreciation you've taken against that equipment will be in another credit normal account called accumulated depreciation. And in the financial statements, they'll be subtracted from one another. Okay, but in the accounting system, one is just a debit balance, and the other is a credit balance. Okay. Okay. So now here are some conceptual questions. Okay. First one: what is the difference between a trial balance and a balance sheet? Okay, think about this. Make sure you're extremely clear about what the difference is. I just talked about it for a couple minutes, but think about it. If you don't know the difference, think about what is the confusion. Yeah, I guess we'll see if you know this or not. If you don't know it, then there's just some fundamental thing that you've missed. Okay? Raise your hand if you can confidently explain the difference between a trial balance and a balance sheet. They have similar names, but they're totally different things. No one can explain the difference. I know you can. Anyone else? No one else can explain the difference. Yeah, what's your name? Crystal? Crystal, okay. Okay, yeah. So the balance sheet, again, is a report that's just showing our basic uh, accounting equation, right? It's going to list assets equals liabilities plus equity. It's just going to show that balance, right, in a report format. There's no debits, there's no credits. It's just going to be numbers and descriptions of what those accounts are. The trial balance, it's going to list all your accounts. It's going to have all the revenue accounts. It's going to have all the expense accounts. It's going to have the dividends. It's going to have every single account in your accounting system listed by their credit or debit balance. There's some order to it. So you can see at the bottom here, these are all your income statement accounts. So this is what's going to go on your income statement. You're going to then combine it with these kind of to give you your equity statements. Okay, so basically your statement of retained earnings and your statement of shareholder equity. And then all this stuff up here, these are your assets and your liabilities. Okay, because remember, the information from the income statement, the net income, is then incorporated into your statement of retained earnings, the ending retained earnings balance. And you can see here, there's a balance here. This is a starting balance. Because remember, for statement of retained earnings, we have the starting balance plus what? The starting balance for retained earnings plus net income minus dividends equals the ending balance, right? So that ending balance of retained earnings then goes into your final balance sheet. So all this stuff, this gets kind of netted together into your ending retained earnings balance, and then that goes in your balance sheet. And then that's combined with all this stuff. So eventually all the balances get included somewhere in the financial statements. Okay? But you're listing them all out here in the trial balance. Yeah.
Well, retained earning becomes this on its own.
Yeah. Yeah.
Besides the reported fair trade.
Yes. Because look, I showed this to you guys, but let me show it one more time. Remember, every period we have an ending retained earnings balance. We take the net income, we minus the dividend. So in the first year, this is my ending retained earnings balance. In the next year, there's a starting balance, this. I'm going to add my net income minus my dividends, and I get an ending balance. And so this $50 is the starting balance for the next year. Okay, and then that gets updated with the net income and the dividends we paid. So that retained earnings balance just keeps getting pushed forward, and we update it depending on what happened in that year. Okay.
We enter with an item, we go step bonus credit.
Right.
It's not
okay, it will. In chapter 4, we will see how in the accounting system we will debit and credit retained earnings. So you're right. That's a great question. Yes, you're already seeing ahead, which is great. Okay, but we're going to hit that in chapter 4. Yeah, because you will have to, you're right, actually update that account in your accounting system with a debit or a credit. Yes, so you're right. It will happen. Okay. So I think we should discuss one more thing. What happens in your trial balance if the debits don't equal the credits? Okay, so we can see here that they're equal, 47,000, 47,000. That means that as long as those two are equal, my balance sheet in the end, when I go through this whole process, the balance sheet will balance. Okay? So what happens if my debits and my credits are not balanced in my trial balance? Okay, something is messed up. So there could be a couple of things. Number one, you could have forgotten some account. Okay, again, if you're using this software, it's not going to forget, right? It's like automated. Okay, but for your homeworks, you're gonna have to like kind of double check that you didn't forget some account. Okay, so that could throw it off. If you just totally forgot to include accounts receivable, your credit balance is going to be more because you forgot this debit balance of accounts receivable. Okay, you could have switched what should have been a debit balance with the credit balance. So if you put accounts receivable, but you put it as a credit balance by accident, that's going to throw it off. Okay, so you have to make sure that you have put the debit or credit balance in the right side of the trial balance. And this math, let's say you had 10,000 on the credits and 18,000 on debit 10,000, credit 18,000. The difference is 8,000. And if you divide that by 2, it's 4,000, right? That means that maybe what should have been a $4,000 debit, you made as a credit. Okay, so why is that? So let's say this is accounts receivable. You accidentally put it as $4,000 as a debit. Okay, so what will happen when I correct it? When I make that, you accidentally put it as a credit, it should have been a debit. Okay, so if I move it, right, I now cancel this and I move it here, this 18,000 is going to become what? So this is going to go to 14. And what about this? 14. Okay, so that's why the difference divided by 2 is going to indicate which account is potentially on the wrong side, because it will have double the effect when you correct it. Okay, does that make sense? Okay. Yeah, so this is kind of related to this. Okay, so now let's do a practice problem where we have some mistakes in the trial balance. You got to figure out what went wrong. Okay, so if you open up the Excel sheet, this 2-34A, it's the second tab. It has a problem where you have a bunch of mistakes in your you can already see that the trial balance is wrong. Okay, it's not balanced. There's more. The debit balance is higher than the credit balance, and it's because of a number of errors. Okay, so you're going to go through and you're going to correct the errors, and once you do this, you should see that the trial balance balances. That's how you know that you did it correctly. Okay, so why don't we take a couple minutes and you guys can work on this, and then we can do it together. Okay, just to do the first one as an example, cash understated by 1,000. So I see cash here is a debit balance of 7,700. If it's understated, what does that mean? Is it too low or too high? It's too low. So what should I do? Should I add 1,000 or subtract 1,000? Add. Okay, good. So 8,700 cash. Okay. Let's do the second one together, just so we are sure we know what's going on. A $4,000 debit to accounts receivable was posted as a credit. Okay, so I have this account receivable balance of 7,000. So what it's saying essentially, okay, if I have my T account for account receivable, right now the balance is 7,000 debit. It's saying that there was some credit that was 4,000 here, but it actually should have been here. Okay, so what should I do? Let's just put some hypothetical numbers. What's 7,000 plus 4,000? This is 11,000. Okay, and this was 4,000 credit, and that gave us a balance of 7. So what happens when I get rid of this credit and I move it here? What's my new balance going to be? 15,000. Okay, so I basically have to add double, right? It's not just adding the amount that was the wrong amount, it's double that amount. Okay, right? Because we went from 7,000 to 15,000 when I corrected that. Did everyone follow? I just made this up. So let's say, yeah, yeah, yeah. So just to get this to work, I just said 11,000, 4,000, assuming there were only two entries. We actually don't know how many debits and credits there were, right? But if this were the case, we would get to this $7,000 balance, right? So now when you move it over, it's like it just makes the math easier to see what happens. Yeah. Okay. So everyone good with that? So we're gonna double the mistake and add 8,000 to this, okay, to get 15,000. So this is going to be 15,000 accounts receivable. Okay, so now keep going. The next one is what? Let's see. Okay, yeah. So I would say just make a fake T account and just see what happens, right? So wait, it was equipment is incorrectly transferred as 87,000. Okay, it's actually not difficult. Oh, C. Okay. So $1,000 purchase of supplies on account was neither journalized nor posted. So it says this is maybe you're overthinking it because it's just like this was never uh, there was a debit or credit to this account that was never put in there. So now you're gonna just put it in there. So there's a journal entry that you'll have to do. It's gonna change two accounts. This one. So think about which two accounts are going to be affected. Okay, so what do we leave off with? This account receivable. Okay, so letter C. A purchase of $1,000 of supplies on account was neither journalized nor posted. So we just have to think about what was the journal entry to buy $1,000 of supplies. So it is gonna be what? What do I debit? Now I got my seating chart, so I'm just gonna pick random people here. Austin, what do you think? What's the journal entry to buy supplies? Austin is right. What is that? Just so what are we gonna debit? What are we gonna credit? What accounts are involved with this purchase of supplies on account? You don't know? Okay. What about uh what about Precious? Who's Precious? Zoe. Zoe's real. Yeah. What do you think? Can you help me? For the purchase of supplies that we did not journalize, right? So we bought $1,000 worth of supplies on account, and we just did not do the journal entry. So now my question is, what is the journal entry that I should have done? Well, I'm not using cash. So look, the key system that we need to do is read what happened. What is the transaction? First question, what accounts are involved? There's no mention of cash in that description of buying supplies on account. Okay. One obvious account is supplies, right? It's telling you this. Don't overthink this. Okay. Supplies. We're buying supplies. Is it going to increase or decrease our supplies account? We're buying them. Increase. What kind of account is supplies? Is it an asset? Is it a liability? Is it a revenue? Is it an expense? Or is it a dividend? Asset. Okay. Asset increase. Now we're ready to do the journal entry. Is it a debit or a credit? Debit. Okay. So supplies, $1,000 debit. Credit is going to be, we didn't pay for it with cash. We bought it on account. Accounts payable. Thank you. Payable. That's a P, not a R. That's the journal entry that that we did not include. Okay, so now we have to change this. Okay, we have to add a debit to supplies. So if we go back to our T account, our trial balance, we see that supplies is at a $700 debit balance, but it's not including this other debit for 1,000. So what is it going to be now when we include it? 1,700. Okay, so 1,700 is going to be the new balance of supplies after we correct for this. And then accounts payable, it's a credit balance of 3,000. We're adding another $1,000 credit to this. So what is it now? Is that 3,000 to go up or down? It's already a credit balance. We're going to credit it 1,000 more. Up. Yes, it's going to be a $4,000 credit balance. So let's see. Let me just make sure. Equipment. Okay, this is accounts payable. Okay, so now this is going to be, instead of 3,000, 4,000. Okay. Okay, so next. So any questions on this? Is that when it says neither journalized nor posted, meaning you just forgot to do that journal entry. So you have to figure out the journal entry is and then update the accounts accordingly. Okay, so the next one. Equipment was incorrectly transferred from the ledger as 8,700. It should have been 78,500. So you just switch some numbers around. So we see equipment is 87,000 here. It's a simple fix. You just change this to 7,850. Okay, so if we go to equipment, we just make it 7,800, 78,500. That's it. Simple. Okay. Salaries expense is overstated by $200. So if I look here, salaries expense, 3,600. You whatever screwed up, copying it down, you made it $200 more. So how do we fix that? It's quite simple. You just reduce it to 3,400. Okay. So accounts payable, notes payable. Common stock. I'm just copying the accounts down. Okay, so what did we say? That salaries expense should be 3,400. So I'm just going to make it 3,400. Okay. A $400 cash payment for advertising expense was neither journalized nor posted. Now you can see here that there is no advertising expense account. So it had a zero balance. And we just didn't do this journal entry. Okay, so what should the journal entry have been? It's the same exercise that as we just did here. So what accounts were involved? What about Roger? What do you think? What is that? Advertising expense? Advertising expense, okay. And what else? How are you paying for that expense? Cash. Okay, good. Okay. And how much was it? 200 bucks? 400. Okay, I'm crediting cash. It's going down, right? I'm paying money out. Expense accounts are debit normal. So, that's why it's getting debited. Okay, so I actually have to add a line. Okay, I have to add a line here for advertising expense. 400. And I'm going to reduce my cash balance. It's a debit balance, but we're crediting it 400. So that's going to reduce the debit balance. We're still going to have a debit balance. It's just going to be lower by 400 because it's getting credited. It's going to be 8,300. Okay. Okay. Where do we leave off here? Okay. So, why don't you take now? Hopefully you can finish stuff. This next one is a little challenging. Take 5 minutes. Try to finish this off if you haven't. And then I'll just do the last couple.
Can you scroll down?
Okay, so I think we're on this last G, H, and I. Okay, a $200 cash dividend was incorrectly journalized as 2,000. Okay, so that means that the dividend balance 4,400 is wrong, and the cash balance is wrong. Okay, so is the dividend 4,400 overstated or understated? Yeah, there's too much dividends in there, right? We have too much. There's extra dividends that shouldn't be in there that are there. So how much lower? How much extra did we put in? 1,800, right? It was 200 is actual. We put in 2,000, which means the extra amount we put in was 1,800, right? 200 plus 1,800 is 2,000. So dividends is overstated by $1,800. So if we just do 4,400 minus 1,800, that's what it should be. It should be 26. We took out too much cash, right? We credited cash by 2,000. We should have credited only 200. So what do we got to do? What do we do? Is this balance over or understated? Understated. Okay, so that means we have to add back 1,800. Okay, I don't know. Let's see. I have the answers, but let's just try to do this. Okay, so service revenue is understated by 5,000. Okay, so this is just another example. We just add 5,000 to the existing balance. So 4,700 is the existing balance plus 5,000. Okay, and then this last one, a 12-month insurance policy was posted as a $1,200 credit to prepaid insurance. Cash was posted correctly. So this one, you need to do a little meta, okay? What should the journal entry have been for this? Okay, so it's prepaid insurance and cash. Okay, and it's saying that the cash was correct. Okay, so you're paying for an insurance policy. So is that a debit or a credit to cash? Is cash going in or out when you pay for something? Out. Okay, so cash is going to be, and what was the amount? 1,200? Okay, so we know that cash was credited and it was credited correctly. What should have the debit been? Prepaid insurance. Okay, exactly. And what kind of account is prepaid insurance? Is it an asset? Is it a liability? Is it a revenue or is it an expense? Asset. You get 1 year of benefit. You're paying your insurance company on January 1st, and you're going to have insurance for the whole year. Okay? So that's an asset. You get a future benefit for that payment up front. Okay? So what they're saying is that you just didn't post this correctly. You put this as a credit instead of a debit. So that means we apply our double rule, right? We have to increase prepaid insurance. It is $800. We have to add $2,400 to that. Okay? It's double the mistake. When you switch to debit and you put it on the wrong side, it's not just adding that amount, it's adding double that amount. Okay? So 800 plus 2,400 is what that prepaid insurance is going to be. So 800 plus 2 times 1,200. You can just do it like that to make it explicit. Okay? And then I think there's a couple of these accounts that were unaffected, notes payable and common stock. So 50,000. Common stock is 51,700. Okay, moment of truth. Okay, so I'm going to use my sum formula. I'm going to add up this. Oh, something is off. Okay. Oh, my rent. Okay, sweet. Okay, we're good. Okay, a little Excel trick I'll show you. I have a formula here, okay, where it's adding up that entire that column, okay? If I want to just have that same formula to supply to the next column, there's a couple ways. I can just copy this cell, Control C, then Control V. Okay, let's just see what this did. It just moved it over. Excel is smart enough where it can like follow patterns. Okay, so it just moved the column over because I copied and pasted one cell over, just moved the cell references over one. Okay, the other way I could do this is if you hold Shift and you go press the right arrow, I can keep going, but let's just say I wanted to only apply it one cell to the right. I hold Shift, go to the right one, let go of Shift, and if I do Control R, it will apply the formula rightwards. I can apply it 100 cells to the right if I wanted. Okay? So it works. Our trial balance is balanced. Okay? All right, any questions on this? What did anyone find messed up here? Yeah.
How do you know the difference between fee or salaries? It's only the salaries are affected, but when we talk about dividends, it's not only dividends are affected. Yes. Well, so how can we when one column identify the salary?
Okay. So sometimes it says understated or overstated. If it only mentions one account is overstated or understated, it's just going to affect that account. If it says that it was journalized incorrectly, that means that both pieces of the transaction were wrong. Yeah?
The keyword.
Yeah, journalized, posted. Yeah, so yeah. Yeah. Yes, exactly. Cash was done. It was only half that journal entry that was messed up. Yeah. Okay, any other questions? Okay, all right. Why don't we take a couple minutes break? And then Monday is a holiday. Okay, so uh okay, so we have our our accounting equation, assets equals liabilities plus equity. We talked about this is the operations, right? This is how our business generates revenue. It's like your cash, it's your equipment, it's all the stuff that you use to conduct your business. And we talked about how this side is the finance side. This is how we pay for all that stuff that we need to conduct our business. So now my question is, why would you ever borrow? Okay? What is the benefit of taking on debt? Why do businesses do that? Does anyone have an intuition or an answer? Why would you not just bring in new owners and not worry about having to pay off a loan? and worry about bankruptcy? Why do companies borrow? Okay, but let's say you could access owners. There's enough investors, like stock market investors, where you didn't have to borrow. You could just go out into the stock market and just raise a bunch of money. Because some companies do that, right? Like Microsoft, like the tech companies, they don't have much debt. Well, now they do because they're building all these data centers. But when they first started, they probably had no debt. They just had equity investors. So why do some businesses borrow? Yeah. What was that? Well, some companies never pay dividends. Berkshire Hathaway has never paid a dividend. So a company is not required to pay dividends. They choose to if they want to return money back to their owners. Okay? Yeah.
It's an idea.
Okay.
If you get money now, for winning out inflation, and on way. So if you're gonna have money today, there's no dividends or anything. You turn money around and repay the debt and
Yeah.
the benefits back to the company.
Okay. Yeah, the benefits back to the company. This is the key thing, right? You as the owner, you want to maximize your returns. Okay, so we're gonna go more into this decision that's made in corporate finance of how much to borrow later in the class. But I'll just leave this idea with you in simple terms of a house. Okay, if you buy a house for 500K, let's say you buy it all cash, so zero borrowing, and you pay $500,000 of cash. Okay, let's say it goes up to 700,000. Okay, you're gonna have no liabilities, but now your equity, your net worth as the owner, is also going to be 700. 500 of your contributed capital and $200 in earnings, right? We can say. Okay, so now let's do the same movement on your asset, your house going up, and so okay. So final thing, what is the return on this? Okay, you invested 500, you got $200,000 in kind of earnings. What percentage profit, you can say, have you made? 2/5, 40%, right? This is your return on your investment. Do we agree? Yeah? Okay, so let's do it now with using a mortgage. So you have 500K. Let's say you borrowed 450. Okay, and then you put up 50,000 of your own dollars. Okay, so your down payment was 50,000, you borrowed 450. Now it goes up to 700K. You still have 450 in debt plus. Now to make this balance, it's going to be what? 250? 250. It's not entirely right. Okay, so let's do a little bit of extra details here. If you were to sell the property, okay, you're gonna have to pay interest too. Okay, so let's say you had to pay 10% interest. Okay, let's just make it kind of easy math. So you're gonna pay $4,500 in interest. Okay, or 45,000. Sorry, right? 450K times 10%, 45,000. So you're going to receive 700,000. So it's going to be on this side in cash, 700K minus 45K in interest. And let's say you're going to pay off your debt, minus 450K. Okay, so what is the math here? How much cash are you going to have at the end of this? Someone want to help me? 450, 250, 205, right? 205. So you're going to have $205,000 in cash. no debt, and 205K in equity. Okay, so you actually have like less equity value, right? In this case, you had 700,000 in equity value. But let's calculate our return on our investment. Okay, so of this 205K, remember we only put up 50K. How much is profit? 155K. We've tripled our money. Okay, so this is like whatever, over 300% return. So greater than 300%. So your return on your equity dollars when you use leverage is far higher if things work out. This is why businesses will try to borrow, because the owners of the company want a higher return. Okay? Yeah, Richard. I did. I've subtracted 45,000 right here. Okay? So, yeah,
The first example did not include it.
I didn't borrow anything. The first example, I had zero debt.
Didn't have.
Yeah? So yes, you're paying interest, but you're getting a ton of leverage. Okay? You're using someone else's money to control a $500,000 asset. And if that asset goes up, then your equity returns are going to be much larger. Okay? So this is the basic fundamental benefit of borrowing. Of course, if things go badly, your equity dollars can get wiped out much more easily too. Okay, because if it had gone from 500 to 450, okay, in the first case you're okay. You're only losing $50,000 of your $500,000 investment. If it goes down to 450K, you're gonna lose all of your money. Okay, so your 50K here will be wiped out because the bank still wants their 450 back. Okay, so leverage cuts both ways. Well, in the case that we had a mortgage, 450K plus no equity value, because the bank, you'll still owe this 450. You'll sell the house, you'll pay off the bank. You'll be left with no money of your own. That's why people will lend, because if things go badly, they want to have their dollars out first, right? That's why some people choose, if you have $100, you'll lend it to someone rather than invest it as equity. Because when you invest it as equity, you're taking more risk. Okay? Okay, so we have a way of measuring this, this ratio between our finance side of the accounting equation. Okay, we call this the debt ratio. Okay, you can see here, it's a ratio between, again, you have assets equals liabilities plus equity. This debt ratio is showing what percent of your assets are financed with debt. Okay, so if you had $100 of assets and you finance $60 with liabilities and 40 with equity, you would get a debt ratio of 60 over 100, which equals 60%. Okay, so this debt ratio is just showing what percentage of your assets are financed with debt. Okay, so what's your intuition? Is it riskier or less risky to have a high debt ratio? What do you think? Is your business taking more or less risk as you have a higher debt ratio? If your debt ratio is 90%, so you see here 90%, that's highly levered, meaning if you have $100 of assets, you finance that with $90 of borrowing. Now, is that risky? It is, okay? So the higher the debt ratio, the more leverage there is on your balance sheet, meaning that if things go well, you're going to have a very high return, but if things go badly, you're going to get wiped out real quick. This is why we always have bank failures. Banks are on this category of highly leveraged. Okay, so if their loans or whatever assets they have, they even go down 10% in value, the bank is bankrupt. Okay, so you know, lower leverage companies, they're gonna, unless they're a really great business that has high returns, like software or like a service business, um, you know, those companies can get away with having low leverage because they earn so much just from whatever services they provide, and they don't need many assets, right? Like if you're an accountant, all you need is like your house. You can even work from your home. You don't need any assets, so you don't need to borrow anything, right? You're earning a lot with very few assets. But some companies, uh, they need to borrow a lot to make it work, to make the returns high enough to kind of make it worth their while. Yeah. Yeah, banks are like around that. Yes. Yes. So, but yeah, that, I mean, all banks are like that. It's not like there's one that's chosen to do that. In order to earn enough profit to justify having the business, they have to use a lot of leverage. Okay, because they're only earning like, they borrow from the depositor at 3% and they're lending at 4%. Okay, so that 1%, it only will add up to a lot of dollars if they have a lot of loans. And they get a lot of loans by just using a lot of leverage. Okay. Okay, so let's now just practice doing journal entries. I think that's how it's a good use of our time. Um, Again, the first tab on here, it's just a series of journal entries. So why don't we actually just pick the harder ones, okay? Um, why don't you guys open it up and I'll look through and see which ones are worth spending time on. Okay, so go ahead and open it up and then we can work on them. Yeah, this one, right? Purchase supplies and furniture on account. Okay, so three accounts: supplies, furniture, and accounts payable. Okay, that's why I threw this one in here, because it's a little curveball here. There's three accounts. Okay, so I have supplies, which is an asset, furniture, which is an asset, and I have accounts payable, which is a liability. So supplies, I think it was 500, furniture 900, accounts payable, I just add these up. I'm going to owe this total amount, 1400. So my rules of journal entry: at least two accounts, my debits equal my credits. Okay? Yeah, 1900. Sorry. Okay, so look, this is the beauty of, did I do this? Okay. 19, what is it? 1900? Automatically updated because I used the formula. Okay? That's why we use Excel formulas. I thank you. You just helped me demonstrate the value of it. Okay. So this is November 4th. Okay, next. What did I say? 10th. Performed services for a hotel and received its promise to pay. So I think people are, uh, what is the point of a business? Forget about accounting. What are you trying to do? What's the goal of any business? To make money. What do we call that? Well, you can make money by, earning a little bit and then spending a bunch too. So what are you trying to actually do? Profit. Okay, what is the definition of profit? What is it? Exactly. Having more revenue than expenses. Revenue is everything you're earning as a business. Okay, I think people are like, you're just like, just don't overthink. Okay, the point, when you do something, when you provide a service, when you go to the hair, the barber, and they cut your hair, they're giving you a service. You pay them money. They just generated revenue from that. They did something for you. Okay, so whenever your business earns something by performing a service, selling something, that's all revenue. Okay, so this is going to be revenue that you're earning, and they're not paying you right away. They're going to pay you later. Okay, so one account is service revenue, because again, I performed a service, I've earned money, and I'm going to have this asset called account receivable. It's not yet cash. It's just a promise that I'm going to receive cash in the future, but it's still an asset. Okay, so I'm going to have $1,200, $1,200. My credit is service revenue, and my asset that I'm debiting is account receivable. Okay, this service revenue, again, back to our accounting equation, it's benefiting who? Who is benefiting from that revenue, right? We have assets equals liabilities plus equity. This is equal to contributed capital, retained earnings. This is equal to revenues minus expenses minus dividends. So that revenue that I earned is increasing here, which is increasing here, which is increasing the owner's equity. Okay, so that makes sense, right? The owners are benefiting from any sales, any services, any amount that your business is earning. The owners are benefiting from that amount. Okay, does that make sense? Tying it back to this accounting equation? Okay. Okay, so continuing on. What else do we have? What's the next one? 14th. Okay, so now we have to refer back to our November 4th transaction. We're just paying the furniture off. We're not paying both off. So what should I do? What are the accounts involved? Okay, now I got this. What about Hirsch? What do you think? Okay. Who wants to help him? What about Ruben? What do you think, Ruben? You're not sure? Who knows? Okay, Mohammed, what do you think? Okay, good. Accounts payable, because you're reducing your accounts payable, you're paying some of it off, and you're using cash to pay it down. Okay, so your cash, is that going up or down? Down, right. That's going to be a credit to cash. 1,900, because remember, we're only paying for the furniture, and we're going to reduce our accounts payable by 1,900. So let's just make sure that the T account is working out here, okay? So this is accounts payable. In this transaction, we had a $2,400 credit. We're now having a debit to accounts payable, 1,900. What's my balance? Is it a debit or credit balance first? There's only two numbers here. It should be obvious. Credit balance, how much? 500 credit balance. And does that make sense? Yes, because we only have these supplies that we have to pay for still. Okay, so again, this double entry system is quite coherent and complete and consistent. Okay, so the more you practice with this, the more you're paying attention to the meta. It is really a brilliant system. Okay, okay. Let's see what else. Okay, so the 20th. What happened on the 20th? We prepared a design for a school on account 800. So this is worded a little funny, but what is happening here? What are we? What are the? What is what is our business engaging in here? Work, right? We've provided a service. So what do we call that when we do something for a client? Service revenue. Okay, good. So service revenue, again, we're going to credit service revenue, 800. Okay, and they're not paying us yet, right? So again, this is going to be account receivable. Okay, and then 29th. Okay, paid $2,400 cash for a 12-month insurance policy. That started on that starts on December 1st. Okay, so what should we do? What's the obvious one? What are we using to pay for this insurance? Cash. Okay, good. Cash. It's going to be credited. It's being reduced. Paying $2,400, and it's going to be prepaid insurance, right? Okay, a little preview about the next chapter. We paid this at the end of November. How much insurance is still left at the end of December? We paid for 12 months. 1 month goes by. How many months are still left? 11. Okay, so let's just see that how that is going to play out. This is what the topic of the next chapter is going to be. So we started with debit balance 2,400. How much is that per month? This is 2,400 divided by 200 a month, right? So we know that this balance should be 2,200 at the end of December. So what do we got to do to prepaid insurance? To get it from a 2,400 debit to a $2,200 debit. This is not coherent. Credit 200 to prepaid insurance, right? We're going to debit insurance expense at the end of December, right? Because 1 month has gone by. This prepaid insurance asset is now worth less, and we've paid for that insurance. That insurance expense has now, we had to recognize it. Okay, so this is going to be the topic of the next chapter about kind of as assets lose value, we got to expense them. We're going to have all these adjusting entries that we're going to have to deal with. Okay? Okay, all right, so Monday's a holiday. So I'll see you Wednesday. Make sure you finish the DSM tonight and finish the homework on Sunday.